I'd like to bring in Kathryn Rooney Vera along with Gina Bolden. And I want to pick up on the inflation question, ladies. Treasury bond yields, they have been coming down. The TIPS 5-year break even, that has been coming down fast. We know shipping rates are declining. So those are all positive, right, in the inflation debate. Now, of course, the flip side, today, crude oil surging. On Friday, we're looking for 325,000 jobs. KRV, let me start with you. How are you modeling this? What's going to win out here in this inflation battle?
Well, we have base effects. Base effects, what we mean is that last year in these months, inflation was very, very high. So, of course, inflation is going to decelerate when you have a favorable base. So let's expect inflation to come down. My forecast, Charles, is for 4.5 to 4.7% by year end. And that's pretty good because we peaked in March at 8.5%. No matter what the Fed does, though, in terms of rate hikes, we're still going to have sticky inflation because this isn't just about, $6 gasoline per gallon in New Jersey, where I'm from, or it's not about a 25% annualized increases in food prices or even supply chain disruptions from China. It's really about wage price inflation,
right.
And it's really about both fiscal and monetary stimuli that has really gone off its rocker the past decade. So I think we can expect inflation to remain sticky for the foreseeable future.
Yeah. When you print up about $9 to $10 trillion between the federal government and Federal Reserve, Gina, this is, I guess, what you get. How are you looking at it? Because to me, this is central to how well this market does this year.
Absolutely, Charles. Thanks for having me. The jobs number that you mentioned is still above trend, and we still expect to see job growth because overall companies are hiring. The big question to me is how long can customers keep spending as prices remain stubbornly high? And we think the answer is a very long time. Why? We still think there's a lot of pent-up demand, and consumers still need retail therapy and time away in the pandemic. So we rely on the consumer to get us out of this.
So to that point, though, because we keep hearing about how much cash is out there, and I bristle at the notion $2.5 trillion is out there. So I saw some great work out there that said the top 20% of households, they have $60,000, or coming into the year, they had $60,000 in excess cash. But then your next bracket, your next 20% of folks had $14,000, and then it just gets very depressing when you go from there. So, Gina, when you look at it that way, I mean, essentially it means that very rich, well-off folks are going to have to carry this economy by themselves.
That's exactly it, Charles. And it's not new news that higher earners drive consumer spending. Close to 40% of consumer spending is from the top 20% wage earners. And this was reflected in the earnings we saw in high-end retailers like RH and Nordstrom that did well. And as your previous guest mentioned, the lower end retailers like Walmart and Target didn't do as well.
Right.
So we think that the retailers that cater to the broader income ranges will do well. It's going to be a grind on the economy, and it won't be easy to get more than 2% growth because clearly inflation is a drag.
KRV, let me go back to your scenario because I hadn't heard anyone say inflation was going to come down that quickly. If you're right, what does it mean for the stock market?
Well, inflation's coming down again because of base effects. So
Sure.
It's not because there's some structural improvement in the economy or because prices at the pump are going to come down.
But if it comes down as quickly as you're saying, that takes pressure off the Fed. And if the Fed doesn't have pressure, Wall Street should love that.
You're right, Charles, and I'll add one more point to your positive scenario, which I think is right. If inflation does come down that fast, we're talking 4.5%, then perhaps, just maybe, real wages turn positive. And this would be a great boon for the consumer. I take the other perspective from Gina. I think the consumer is not doing well. The combination of high inflation, the massive hit to the wealth effect, we have, S&P down 20% year to date. That affects people's retirement income, their 401ks, the housing market is turning over. I don't believe in the consumer right now, but if you do get inflation coming down and real wages turn positive, then there could be a light at the end of the tunnel.
Yeah.
But I'm still shying away from consumer discretionary, from tech, and I still favor those defensive sectors that up to this point in this year, Charles, have outperformed cyclicals.
Just in a quick aside, I mean, if you look at the destruction and housing, right, even today, I mean, with the Michigan sentiment number, it's off the charts how low, people just don't seem interested. and that would have a much greater impact on the so-called wealth effect. But let's talk about markets for a moment, because obviously it's been a wild ride even before we came into the day. You know, it's the most we've seen the market move 1% in any given session going back to 2008. So, Gina, how are you dealing with this? How are you dealing with this sort of extraordinarily volatile market that in some ways seems oversold, but the dangers are still maybe to the downside?
Well, you know, I don't think now's the time to sell, right? As soon as you think about that, it's too late. But we think there's 3 reasons to be optimistic towards the second half of the year. And one is because the market has come down so much, valuations are attractive. The PE on forward-looking earnings is 16 instead of 22. We still think strong earnings will support a stock market rally, and we do expect inflation to ease by the end of the year. So we're bullish, although we're cautious. We do not know if we're at the bottom. Bottoming is a process. We could retest the lows, but we think we'll have a better half of the year.
I got a minute left, Kathryn. How do you ride out the near-term bumpiness of this market?
See, I'm more cautious than Gina, perhaps. I think cash is an asset class that everyone should have and even accumulate. I think that we should be in alternatives. I think we should have defensive. And my view is that recession is on the horizon. It's inevitable. It's part of the economic cycle. And if, in fact, we do get the consumer rolling over and some hit to the labor market, I think we need to be defensively positioned. So we can't count on, you know, the Fed put. The Fed has a double-barreled approach now. It's not just increasing rates, it's also letting the balance sheet roll off. So that is a double whammy. We already see a tightening of financial conditions. It's just going to get worse. So I would be very cautious, very careful, and get defensive.
Yeah, unfortunately, the Fed put is kaput.